Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss about JAIIB Accounts paper, some important topics and recalled questions from various examinations. Now, this is bank's balance sheet schedules. Bank's balance sheet schedules. Bank balance sheet schedule preparation as per Form A of BR Act 1949, Form A of BR Act 1949 and third schedule of the Companies Act 2013. So Form A of Banking Regulation Act and third schedule of the Companies Act 2013, bank has to prepare the balance sheet. These are the liabilities. Credit side is liabilities, debit side is assets. Now liabilities, credit side and source of funds. These are the source of funds. Debit side, assets, application of funds or utilization of funds, use of funds. Now liabilities, schedule number 1, capital. Schedule number 1, capital. Authorized capital, issued, subscribed and paid up capital details are there in schedule number 1, capital. Schedule number 2, reserves. Reserves, various types of reserves are there. All types of reserves are there in schedule number 2. In this statutory reserve, capital reserve, debenture, all types of reserves. All types of reserves are there in schedule number 2. That is reserves. Schedule number 3 is deposits. Deposits means here current deposit, savings deposit and time deposit. Schedule number 3. Schedule number 3, deposits. Schedule number 4, borrowings. Borrowings from others. Borrowings from other market. Borrowing from other banks, market, money market, long-term borrowings. All will come under borrowings. Schedule number 4. Schedule number 4. Schedule number 5, other liabilities and provisions. Any other liabilities and provisions are there. Provisions on standard advances. All other provisions will be there in schedule number 5. Liabilities, schedule number 5, other liabilities and provisions. So, in the liability side, credit side of the bank's balance sheet, source of funds, 5 schedules are there. Capital, reserves, deposits, borrowings and other liabilities. These are 5 schedules. Now coming to asset side, this is the debit side, application of funds, use of funds or utilization of funds. Schedule number 6, cash on hand, balance with RBI. Cash on hand and balance with RBI. This is schedule number 6. Schedule number 7, balances with other banks. Schedule number 7, balances with other banks and money at call and short notice. Money at call means overnight. Short notice means up to notice money 2 to 14. Term money 15 days to 1 year. All will come. Balances with other banks. Money market borrowings also will come under schedule number 7. Schedule number 8, investments. Investments, banks investments. Schedule number 9, advances. Schedule number 9, advances. Total advances. All fund-based advances will come under schedule number 9. Schedule number 10, fixed assets. Bank fixed assets. Schedule number 11, other assets. Schedule number 11, other assets. So these are assets are 6 to 11. 6, cash on hand, balance with RBI. 7, balance with other banks, money at call and short notice. 8, investments. 9, advances. 10, fixed assets. 11, other assets. Primary function of the bank, main function is accepting of deposits for the purpose of advances. After that, next most important function is investment. First advances, after that investments. So this is about the bank's balance sheet schedule. 1 to 5 is liabilities, 6 to 11 is assets. This is about bank's balance sheet schedule 1 to 11. Now schedule number 12, contingent liabilities. contingent liabilities means footnote item in the bank's balance sheet. In this contingent liability, off balance sheet or non-fund based advances are going to be parked under schedule number 12, contingent liabilities. Now, what are the last time also 2 marks they had asked this question. Claims against bank not acknowledged as debts. So debts not acknowledged by the bank as debts, that will come. Liability for partly paid up investments. For example, partly paid, partly unpaid investments are there. The unpaid amount of the investments are going to be shown under this liability for partly paid up investments. Liability on account of outstanding forward exchange contracts. So foreign exchange forward contracts are there, that is going to be shown under, this is part of derivatives exposure. Liabilities on account of outstanding forward exchange means foreign exchange forward exchange contracts. Guarantees given on behalf of customers in India, outside India. So this is guarantees given. Acceptance on behalf of others, endorsements on behalf of others, and other obligations on behalf of others will also part of schedule number 12, contingent liabilities. Now, they are asking in the examination question, which of the following is not part of contingent liability? That's why you have to understand the very clearly what are the meaning of contingent liabilities. Other items for which the bank is contingent liable. Contingent means may liable, may not liable in the future. That is called as contingent. As footnote, schedule number 12, we are parking this non-fund based advances or off balance sheet item. Now, this is profit and loss account of a bank. This is also third schedule of Companies Act, Form B of Banking Regulation Act. Form B of Banking Regulation Act and third schedule of Companies Act 2013. Now, 4 schedules are there in P&L account. 4 schedules. What are the income schedules? Interest earned. So, interest earned means interest on advances. Schedule number 13. P&L, schedule number 13. Interest earned means interest on advances. 13. Schedule number 14. Other income. Other income means exchange, commission, in dividend on investments, profit from sale of fixed assets, profit from sale of foreign currency, all will come under other income. Processing charges, exchange, other income, schedule number 14. So, interest income is schedule number 13. Interest received or interest earned, schedule number 13. Other income, schedule number 14. This is total of income. Then expenditure. Interest expended means interest on deposits. Whatever the interest we are paying on deposits, that is schedule number 15. Interest on deposits expended. Schedule number 16, operating expenditure, salaries. Any other operating expenditure means salaries, rent, advertisement, electricity, everything will come operating expenditure, 16. So after that, this is total of income, expenditure. Income is more than expenditure, you will get profit. And provisions and contingencies. What are the provisions we are providing? That also you have to deduct separately. Provisions is also part of expenditure. Provisions means debit P&L, credit respect to head. That's why provisions and contingencies also we are debiting to P&L nominal account. That is an expenditure. That after that any surplus is there, income is more and expenditure is less, the bank will get profit, or expenditure is more, income is less, the bank will incur loss. This is about the 13, 14 income schedules, 15 and 16 expenditure schedules. Now, sometimes they are asking operating profit, means profit before operating expenses is called as operating profit. This is also one. This is about schedule number 13, 14 income, 15, 16 expenditure of banks. Now after that, the profit they are going to, banks are also going to transfer to profit and loss appropriation account, or in companies also, normal in company accounts also, final accounts company also, after completion of net profit calculation, they are transferring to profit and loss appropriation account, utilization account. Whatever the net profit we are getting, how we are going to appropriate or how we are going to utilize. This we are using in the bank, and in Companies Act also, all the companies they are doing this. Now, this is the credit side, P&L appropriation credit side, and this is the debit side and credit side. Now, first I will talk credit side. By last year balance brought down. When any previous year remaining surplus balances in P&L, we can transfer to P&L appropriation account. By net profit of the current year, this year current year net profit also we are brought down from P&L, net profit from P&L brought down, plus by excess income tax provision of earlier years. In the earlier years, we had paid excess income tax. In the current year, we are getting back. That is called excess income tax provision of earlier years during the current year, which you have received. That is also credit. Now, this is a question they are asking. Excess income tax provision of earlier years, whether debit of P&L appropriation or credit of P&L appropriation. That is, answer is credit of P&L. Now, debit side, transfer to reserves. From this amount, how they are going to appropriate, how they are going to utilize, transfer to reserves. It may be statutory reserves, any other reserves also. Now, transfer to debenture redemption reserve. Just like the company or the bank has issued debentures, for the redemption, every year they will transfer from amount from P&L appropriation. Current year income tax provision, debit. Interim dividend, any interim dividend which was paid, that. And on the dividend, final dividend or interim dividend, dividend distribution tax. As for Income Tax Act, the company, the bank has to pay the dividend tax on dividend. So that is called dividend distribution tax also. It is going to be debited to P&L. And current year proposed dividend, any year, any dividend proposed during the current year, that also it will come. Then after any surplus is there, that is going to be transferred to reserves and surpluses. Surplus carried forward to the balance sheet, reserves and surplus. This is the total, this is the. Now they are asking, surplus is there, that you are going to transfer to reserves and surpluses. So, surplus means that is a liability to the firm, that is a liability to the bank, that is a liability to the company. So, net profit or net profit surplus is a liability to the firm, bank or company. That question they are asking, this one. This is about P&L appropriation account. 1 mark they are asking compulsory. Now we have discussed balance sheet schedules, contingent liabilities and P&L schedules and P&L appropriation account. Now bills receivables. Bills receivables is a real account, current assets. Whatever the bills receivable outstanding amount is there, that is a real account and current asset. These are all our examination questions which they are asked earlier. Bill of exchange is an unconditional order to pay. Bill of exchange definition, it is an unconditional order. Accommodation bill, without any consideration or without any genuine business transaction, that is called accommodation bills. Without any consideration, without any business. Even accommodation bills also part of current assets, real account. They are asking that accommodation bills are dash account, real account. Foreign bills, drawn in India, payable outside India, or drawn outside India, payable in India. That is called foreign bills. Foreign bills. Parties involved in a bill, 3 parties: drawer, drawee, payee. Drawer, maker of the bill; drawee, buyer of the goods; drawer, drawee, payee, beneficiary. That is the parties involved. Retirement of a bill. Retirement means when the drawee is making the payment under the bill before its due date. Drawee is making the bill before its due date. That is called retirement of bill. Noting means recording the facts of the dishonor of the bill. Noting. As per NI Act section 99, what is meant by noting? Recording of the facts of the dishonor of the bill. We are noting separately, that is. Noting charges are paid to notary public regarding dishonor particulars. You have to pay the notary charges by a advocate notary public. Section 100 of NI Act protect the dishonor of the bill to be noted by a notary public, and he will issue a certificate that is called as protect. Why we are doing dishonor of bill by a notary? It is additional security, better security at the time of filing of cases. That is the dishonor protect. Now, who will pay the noting charges? Drawee, defaulter. Drawee means which has not honored, that is drawee has to pay. When the due date of the bill falls on a public holiday, it is payable on the preceding or earlier working day. When the due date of the bill of a public holiday, maturing on a public holiday, it is payable on the preceding or earlier working day. Now, these are the questions which were asked in various from the last 5 or 6 years. 5 or 6 years in various examinations about the bill of exchange, theory based questions these are. Now, credit monitoring arrangement, CMA, credit monitoring arrangement. What is meant by, at the time of processing of the loans in the bank, you have to use these forms. That forms is called as credit monitoring arrangement. All banks, this is applicable to all banks. CMA form or format 1, format 2, etc. Form 1, particulars of existing limits. What are the existing limits of the party? Under form number 1, we are mentioning existing limits and its present outstanding and status of the account. Any overdues is there, any SMA 0, SMA 1, SMA 2 or NPA category or any overdues are there. That status he will, existing limits with outstanding limits he will mention. Number 1, form 1 is particulars of existing. Form number 2, operating statement. Operating statement, trading account and P&L. Trading and P&L account of the borrower, firm or company. So, from the trading account, from the operating statement, we are getting gross profit, net profit. And total sales, total purchases, total operating expenditure also. Total purchases, total sales, total direct expenditure, indirect expenditure, total operating cost. Then finally profit. End result is profit. That is called operating statement. This is operating statement means trading and profit and loss account means it is a nominal account. In our normal sense, it is a nominal account. Debit all expenditure, credit all income and gain. Operating statement. Analysis of balance sheet. So, form number 3, analysis of balance sheet means credit side is liabilities, debit side is assets. Credit side liabilities, debit side assets. What are there in the liability side? Net worth, capital, long-term loans and current liabilities. In the balance sheet analysis, liability side, first net worth, then long-term liabilities, then current liabilities, then total liabilities. Then coming to asset side, non-current assets, current assets. Asset side, as per Companies Act 2013, assets are 2 types. One is non-current assets, another one is current assets. In the non-current assets, fixed asset tangible, fixed asset tangible fixed assets and intangible fixed assets. Non-current assets, that is non-current. Current assets, we know current assets. This is analysis of balance sheet. Then form number 4, comparative statement of current assets and current liabilities. What is the comparative statement from the last 2 years or 3 years? What is the level of current assets? What is the level of current liabilities? With this analysis, we are getting current ratio, total of current assets, current liabilities. Current assets minus current liabilities, we are getting net working capital. And current assets by current liabilities, we are getting current ratio also. Current assets minus stock divided by current liabilities, we are getting asset test ratio or quick ratio. And total of working capital, gross working capital also we are getting. And from this analysis, what is the movement of current assets from compared to last year to this year? Increase or decrease? Same manner, current liabilities. Current assets means receivable within 1 year or one operating circular. Current liabilities means payable within 1 year or one operating circular. This is the normal. For working capital assessment, all the working capital assessment will be based on current assets and current liabilities. Now, form number 5, MPBF, maximum permissible bank finance assessment for working capital. In the bank, this form we are using. Under this form, we are calculating what is the requirement, how we are going to assess the assessment of working capital of the company or firm or this MPBF. Maximum permissible bank finance working capital assessment. In this format, we are calculating what is the level of current assets, what is the level of current liabilities, what is the working capital gap, what is the margin, what is the MPBF eligibility. Working capital gap minus margin, current margin, then you will get to MPBF. Then finally, form number 6, fund flow statement. Funds, how the firm, how the company, how the bank is getting funds inside. What are the sources of inflow of funds? That is one. Same manner, how we are utilizing the funds, outflow of funds. Statement of inflow and statement of outflow of funds. That is called fund flow statement. So it is a dynamic statement. Fund flow statement is a dynamic statement. How the funds are coming in and how they are utilizing. Any surplus, total inflow of funds minus outflow of funds by the end of the quarter. Normally fund flow statement we are preparing on quarterly basis. At the end of the quarter, what is the total inflow of funds? At the end of the quarter, total outflow of funds. Any surplus is there, positive gap or negative gap. That is the this is called fund flow statement. So these are the things which they are asking in the examination. And in addition to examination, these topics are very, very important for working in the banking industry also. Dear viewers, thank you very much for all for extending support to our YouTube channel. Thank you very much for all for watching our videos regularly.